Hello everyone, welcome to this edition of Know Your 4C Fund Manager. I am Narender Reddy, Head of Investment Advisory at Motilal Oswal Private Wealth. Today we have with us Mr. Dhawal Dalal, CIO Fixed Income at Edelweiss Asset Management. Dhawal is an industry veteran with close to 2.5 decades of experience in fixed income markets. He's been with Edelweiss for over 6 years now, and prior to this he was with DSP BlackRock Asset Management for about 18 years. He's done his MBA from University of Dallas in USA and worked with Merrill Lynch Asset Management for 2 years before moving back to India. It's such a pleasure having you here with us.
Thank you, Narendra.
And while we would like to know more about the focus of Edelweiss as a fund house and its foray into the passive products, we would want to get started with your views on global macros, especially given the backdrop of last 3 years where we have seen spectacular action both in terms of COVID-related loose monetary policy that we have seen central banks kind of resorting to, and then we have had inflation spike, and now we are seeing recessionary fears. Also, beginning of February, we had some anticipation markets was factoring in the Fed to kind of pivot sometime in 2023, and your 10-year US Treasury was at around 3.4. And come first week of March, it's already at 4%.
Absolutely.
So there's lots happening in the fixed income markets globally and locally. Would want to get your views on this.
Absolutely, Narendra. As you rightly said, that the fixed income market, particularly global as well as local, is full of excitement, and it's, as they say, you will always live in interesting time, right? So coming back to your point about what happened in the last 3 years, I think the COVID in March 20 actually reset the way global economy was operating. In fact, prior to COVID, things were just moving along in a nice place. The economy was gradually getting into a rhythm, and suddenly COVID struck. And as a result of that, we have seen global central banks cutting rates in a dramatic fashion and pumping liquidity in a unprecedented manner, right? Now, if we have to look back and see, I think the recent inflation problem, a bulk of that is because of the large amount of liquidity which was pumped in by way of giving free money, doling out to businesses, doling out to employees, and so on and so forth. But part of the problem also remains because of, since the global financial crisis, the Fed has remained zero bound for a very long time period. So a toxic combination of zero bound interest rates for a very long time period and then unprecedented pumping of liquidity in the post-COVID world created a very, very potent mixture of what we see in the current inflation scenario. So inflation started rising. It initially crossed 2%, and then before anybody could realize, and initially I think central banks were in the period of that this is transitory, and the whole world was in the transitory camp, but the inflation became well entrenched. As a result of that, we have seen inflation shooting all the way up to 8 to 9%, and in Europe even 11% because of energy crisis. Now we are seeing inflation picking out and central banks waking up from their slumber and taking note and then ratcheting up policy rates very, very aggressive. Obviously, as you know, monetary policy works with a lag. So the rate hiking cycle which started in the first quarter of 2022, now it is going to start making an impact that now we are in the 12 to 18 month period. So a combination of the previous rate hikes as well as easing of the supply side and other measures which have been taken, we believe that the inflation should gradually start trending lower. Now the question is the path of the inflation decline. Now the Fed wants inflation to come back to 2%, which was the pre-COVID level. Now the question is whether the inflation in the US will come back to 2% or it will settle somewhere between 2.5 to 3. That's a matter of debate. And also the trajectory of the decline of the inflation. So these are some of the things which are right now being viewed by the central banks. And as you rightly pointed out that the US yields also has been hovering in a significant manner. In October 2022, the yields were at around 4.3% as the market it was expecting Fed to become a little aggressive. But then there are indications where that the inflation was peaking out and gradually declining, and that led yields to fall all the way to about 340, and now we are back to 4%. Now the curve is inverted, as you rightly noted down, right? Now, the Fed and other central banks are all data driven. And we know that data is never going to be in a secular manner, one way up or one way down.
Yeah.
Even while the inflation is being talked about declining, the question is it's going to decline and then go up and then decline and go up and decline and go up. So we are perhaps in that first phase where the inflation and the employment data is surprisingly strong, and that is what is pushing central banks to reiterate their hawkish stance. But by and large, I think from a technical perspective and the market positioning perspective, we believe that the 10-year will hover between 375 to 4 quarter in the US. And the curve will remain inverted. I think while it's very easy to say, oh, inflation is going higher, Fed should raise rates, but we are also have to be mindful of certain reality. Like for example, in the US, the debt ceiling issue is very, very alive. And it remains to be seen whether the Fed will continue to hike rates when the fear of default because of the debt ceiling issue is going to be clear and present, as they say, right? So that's number one. Second thing is that the US lawmakers will also have to be mindful of the fact that the Fed's action of raising rates is going to ultimately result in loss of jobs. And is it going to be a palatable option for the US senators and representatives to go back to their constituents and tell people that what I do and what I support is going to result in loss of US jobs? So these are some of the real issues that the Fed's policymakers will have to be familiar with. So I do not feel that rates will continually go higher. I am of the belief that in 2023 calendar year, rates will remain stable. They will go marginally higher from the current level, but I am not in the camp which is predicting Fed fund rate to go to 6% or some crazy levels. I think it will be more pragmatic, more realistic action from the Fed.
So in a nutshell, maybe 2 more rate hikes, 2 more 25 basis points each?
I think right now the consensus is that the policy rates will peak out at around 5.4% in the US. Again, let's wait for this week's employment data for February. I think this will give us some amount of indication whether the US employment scenario is still red hot or it's cooling. But I believe the truth always lies somewhere in between. So we should probably hope between 5 quarter to 5 half.
Sure. The other view that's emerging is the US government, to address the concerns around slowdown, will get into significant spending. And that would keep inflation rather sticky, and that would make Fed continue or prolong at a higher rate for a fairly longer period of time, and that could possibly lead to further slowdown. What are your views?
Well, you are right. I think we are right now in a territory where there are no precedences, right? And history is not providing us with any guiding light, particularly in the near term. If you have to go back to 1930s and 1970s, they are different matter. But yes, you are right. The current information provides us that inflation is becoming well entrenched. The pricing power is coming back, particularly in the services sector. People are willing to command more prices, particularly US plumbers, electricians, car mechanic, whatever you want, name it. They are able to get higher prices and customers are paying for it. So this is the reality as of now. Now, I firmly believe that as the previous policy hikes will start making an impact, at some point of time, it will start reacting in a positive manner. You can't have an economy which is going to run hot and pricing power is there and inflation remains well entrenched. So, once the debt ceiling issue is resolved, and I believe it will be, then once again, I think the Fed will start working on its way towards further stabilizing inflation and bringing inflation down. Even because of the base effect, I believe inflation will fall on its own.
Sure.
So we need to be a little more optimistic on that.
Sure. And what would this mean for India?
Well,
Because it was firmly believed that at the beginning of the calendar year 2023 that 6.5 would be the terminal rate.
Absolutely.
But with what's the kind of commentary that's coming from the US, will RBI be forced to kind of do one more rate hike?
Well, that's $1 million question, right? And in order to answer that question, we also need to understand that there is a directional correlation with what US does, right? Because as you know that if the US 1-year T-bill is going to give you 5% dollar yield, obviously that will determine the pricing of a lot of assets globally, including emerging market. So yes, RBI and policymakers will have to pay heed to what is the
Spread between
yes, T-bill or dollar risk-free rate of dollar assets are. That said, I think it is also important to note that now there is a fundamental difference in terms of economic composition, and India's economy is far better shape than what it used to be, and relatively speaking. So although the economic data suggests that in Q3 our economic growth slightly slowed down, but over the medium term, I think the ingredients of the economy, due to number of policy actions taken by the government over the last couple of quarters, is going to result in a very, very robust growth in the economy. Now, India is one of the top 5 economies in the world, right? And while the other economies are going to slow down, I think the Indian economy will continue to chug along between 6% year over year to maybe 6.5 to 7, on if we have to be a little more ambitious. So from that perspective, I believe that RBI will have to, and MPC will have to debate between the growth and inflation dynamic, and make procedural adjustments on the rates. And I think from that perspective, I think 675, whether it happens in April or maybe later, it remains to be seen. The other important point to note is that the current expectations is also being driven by a little stronger inflation for January, which was primarily because of cereal prices, right? And now people are saying that even Feb inflation is going to be slightly on the higher side. Subsequently, I think there will be a very smart correction in inflation in India. So MPC, when they meet in April, they will have to debate whether they want to raise the policy rate because of these 2 months of higher than expected inflation, Jan and Feb, and subsequent decline, or they need to readjust their FY24 inflation forecast. And obviously, they will have to take into account what the Fed does in that. So overall in all, I think it's a close call, whether the RBI will move from 6.5 to 675 or not. But whatever they do, we are of the view that for 2023, it will be the final.
Sure. So the biggest dilemma most investors and us wealth managers are facing today is the deployment of your fixed income portfolios.
Absolutely.
While there is consensus building that for your 3 to 5 years portfolio, your 3 to 6 years, 4 to 6 years segment looks fairly attractive. There's hardly any spread between your 6 years and 10 years. So it's a no-brainer to kind of go and put your money into 3 to 4 year or 6 year segment. However, for your satellite portfolio, where you would want to take the tactical duration call, one would want to kind of time it better. So you think the time has come, or one should wait for more data points and more central bank action to then take a call?
So, Narendra, if you rewind the clock back, and if you look at the calendar return of 21 and calendar of 22, what you will notice is that the fixed income funds have underperformed cash. I mean returns on cash, I meant, right? And that is because of the change in the interest rate cycle. Now, so as a result of that, the investors have had a very low returns from their fixed income portfolio. And now people are questioning the recent uptrend in the bond yields, whether it's going to remain there or not. We are of the view that we are getting into buy zone. And I think while it will be difficult to put a point, now you invest, but I am of the view that 2023 is the area or the time period, at least in the first few months of 2023, you will see yields picking out. And this is the time is for investors, whether tactical or from a strategic investment perspective or long-term asset allocation perspective, it is the time to start investing. Now, how do you capture the average peak yield? You have to spread your bets. So whether you are looking to invest in an actively managed fund, or you are looking to invest in a target maturity or a passive fund, what we are recommending to our client is to spread your bets into 2 or 3 tranches. Maybe and each tranche could be 1.5 months apart. So that if you are investing for 3 to 5 year or even longer tenure, I think this 4 or 5 month delay is minuscule in terms of your reference of investment, but it will provide you with a great peace of mind that you have been able to average it out. Now, given the fact that volatility in the bond market has been significantly higher, like in January we saw US 10-year at 340, today we are looking at 4%, so significant amount of movement is happening. Luckily for us in India, we are not seeing that kind of movement in bond yields.
Thankfully.
That said, yes, thankfully. That said, I think it always helps to suggest a client to spread the bets.
Sure. And also thanks to the measured policy approach both from the government and also from the central bank in India during COVID.
Absolutely.
They were far more measured, and which is why we have not seen significant spike in inflation, which has not been kind of under control, coming under control. So coming to Edelweiss now. So you've been pioneers in the passive strategies. I mean, you were an active fixed income manager for a very, very long time. And from there to joining Edelweiss, which has been focused on passive, what has been the thought process behind the move, and what is it that Edelweiss is thinking through?
No, I think this is a very relevant question, Narender, and this is something that has always stuck our mind, that while operating in actively managed funds for almost 18 years plus, what we realized is that we were not able to solve the client's problems in terms of expectations of returns. See, today when the clients invest in any kind of product, right, there is always an expectations built in that if I remain invested for say 1 year or 3 year or a 5 year, what kind of returns I should expect. And none of the actively managed funds were able to answer that question. And this is exactly when we introduced the target maturity funds way back in December 2019 through Bharat Bond ETF. I think we were able to give some amount of predictability of returns to clients. And this is something that has struck very well with clients. That if I remain invested till the maturity of the product, then what kind of returns I should probably be getting. And this is one of the biggest selling point for target maturity funds. Apart from that, obviously, the structured investment objective wherein clients exactly know what kind of portfolio that I'll be seeing, what kind of expenditures I'm going to make, what is the underlying index, and the liquidity profile, and the last but not least, the most important thing is tax adjusted returns. I think at that point of time when we launched the first tranche of Bharat Bond ETF, the 10-year yield was close to where we are, about 760ish, and the 3-year yield were close to about 670, which is slightly on higher side right now. But at that point of time, the tax-free bonds were trading at close to 5%. And we pitched to our clients that if in India, if average inflation remained close to 5% over a 10-year period, then the tax-adjusted return could be about 100 basis points higher than what you were getting from the tax-free bond at that point of time, and from the similar kind of underlying AAA CPSE bonds. And that idea resonated very well with some of the family offices and HNI clients. And as a result of that, the target maturity funds became extremely popular among institutional investors, HNI, retail, family offices, and everywhere. And I believe that this edge is going to remain there as long as the yields remain very attractive, which we are right now. And I think now we are seeing very nice growth. I think total assets under management under target maturity funds are now almost 1.6 trillion rupees, about 80,000 crore through ETFs and about 80,000 crore through index funds. And I believe that we are going to continue to see exponential growth as more and more AMCs will come out and introduce innovative products in the passively managed funds.
Rightfully so. I think you have the peace of mind of a solid quality portfolio, a lower expense ratio, and predictability of your returns.
Absolutely.
Yeah. And now you're also foraying into short duration index funds.
Absolutely.
What is the thinking behind this?
Yes. So now, as I mentioned, the innovation is the key. And I think we want to provide innovative solutions to our clients. Short duration fund as a category is almost 1 trillion rupees of assets under management. And if you look at its performance, particularly the duration, weighted average duration of all the short-term funds, we believe that it is slightly on a conservative side. If we have to look at the last 5 to 10 years worth of data. And now we want to change the dynamics of how short-term funds are being managed. So in order to do so, we have introduced short duration index funds for our clients. The fund is only going to invest in, the index fund is only going to invest in government securities and SDL. So as a result of that, zero credit risk. Second thing, the expense ratio is quite minimal. So to that extent, money saved is money earned. And the third thing is that the duration of this portfolio is going to be between 2.4 years to about 2.8 years, as compared to average duration of the short-term fund being between 1.5 years to 1.8 years. So say 2 years. So as compared to 1.5 to 2 years, we are going to be between 2.5 to 2.8. So a higher duration, lower expense, high quality portfolio. How does that help clients? Right now, interest rates or bond yields are going to remain stable, but our view is that these things will change in 24 or 25, and at that point of time, higher duration will generate better returns. So we are hoping that this is going to be a very nice innovation for clients, those who do not know whether their money is going to be there for 3 years or 5 years, but at least for 6 months. These kind of clients can consider investing in short duration fund and feel good about it.
Sure. And today, if one were to build a fixed income portfolio, how would you break it down? If somebody is not worried about liquidity, at least from a 3 years perspective, how would you break down this 100 rupees across your short duration index funds, your 4 to 6 years target maturity funds, and some portion into long duration funds?
Yeah. So see, Narendra, it is important to understand that there is no one solution for everyone,
Sure.
right? For anybody any client who has money for at least 6 months, but not more than 3 years, should probably consider short duration fund. And I'm not saying that investors with more than 3 year money should not consider short duration fund, but the moment you have clarity that you are there for 3 years or longer, I believe that there is going to be a toss-up between whether I should be investing in short duration fund or a target maturity fund. In a scenario of declining bond yields, a short duration fund will be a better fund.
Yes.
But in a scenario of stable rates, I think target maturity fund could probably give you higher level of predictability of returns. My view is that right now, given the level of yields that we are seeing, given credit spreads at close to the entire curve right now is above 7.5%, right? Investors will have to figure out what is their investment horizon. In my view, given right now, if investors want tax-adjusted superior return, they should invest as long as possible. But it is very difficult for us to suggest each client to consider say 15-year index fund. So bulk of the clients will probably be happy to put money between 5 to 10. And investors can probably do sort of like a ladder approach, where if you have 100 rupees to invest, maybe they can put 25 in 5 year, 25 in 6 year, 25 in 7, and so on and so forth. So that when the assets mature, they once again you can start going up to the ladder, and your average portfolio duration will be close to about 7-year weighted average maturity. But if any client who feels that I want a replacement of tax-free bonds, then investing in 10 to 15-year segment provides a great opportunity right now, given where we are in terms of tax-adjusted, tax-free bond yields, which are close to about 5.5%, and given where the target maturity yields are, which is close to about 760 to 770, depending on how you look at it, and just lock in and forget.
Sure. While it is very difficult to foresee into future and predict where the rates could be, let's say 3 years, 5 years down the line, or maybe 10 years down the line, it will be very difficult because one would have not anticipated the rate movement in the last 2-3 years. However, what's your broad view? I mean, as India turns into a more developed economy, so do you think rates will eventually start moving downwards going forward?
Absolutely, Narendra, and this is one of the most important driving point for us when we are asking clients to look at 10 years to 15-year funds. See, right now, if you look at, I strongly believe in the India's growth story. And right now, India is a civil engineering project. You go anywhere in India, there is a construction work going on, some sort of construction work, whether it's highways or roads or dams or ports or whatever you want to see. It's all infrastructure being built. Now, the eventually all this infrastructure, when it's going to get completed, they are going to provide us with great amount of efficiency. And the way efficiency is going to be is the reduction in wastages, higher level of profitability, higher level of productivity. And this will result in higher tax to GDP ratio for the government of India. Now, this is something very, very important, because right now India's tax to GDP ratio is about 11%. The moment we start moving to 12, 13, 14%, the kind of money that you will generate for the government is significantly higher. Because 1 percentage point increase is straight 3 trillion rupees at current GDP.
Yes.
Right?
Yes.
So this is something that will reduce the government's borrowing requirements going forward.
Sure.
Even if you look at this year's budget, while the budget expenditure has moved from 40 trillion rupees to 45 trillion rupees, that's about 11% increase, your net borrowing is flat.
Flat, yes.
So what government is trying to do is that while the budget is getting consolidated, your economy is growing, but your borrowing requirement is remaining more or less
Coming down,
unchanged.
yes.
And I believe that the moment this tax to GDP ratio will start moving higher, your borrowing requirements will start falling. And in turn will result in a gradual decline in bond yields. In Asia, if you look at the other countries, only India and Indonesia have 10-year yields above 7%.
Sure.
Okay, so we need to be a little more optimistic. Clients will have to take a slightly long-term, medium to long-term view.
Yeah.
But I am of the firm belief that if our current economic path and policy continue, then we are going to see a gradual decline in bond yields over 5 to 10 year period. And at that point of time, clients will do well to allocate longer money in longer duration funds right now.
Great insights, in fact. So this is a great time to lock in yields for a fairly longer period of time. And what you also said is, given the way US Fed action could possibly be and the necessary follow-up that RBI would have to do, there could be some more upside, and 2023 calendar year could be a good year to kind of build your fixed income portfolios.
Absolutely.
For a longer period of time.
Absolutely.
Sure. Thanks for the great insights, and thanks for taking out time, and I hope our investors find a great use of this conversation. Thank
My
you so much,
pleasure.
Dhawal.
Thank you very much.